Hello and welcome to MC Explains, an investor education initiative brought to you by Moneycontrol and Invesco Mutual Fund. In this series, we talk to you about different concepts around investing in market-linked securities, trying to simplify the jargon and highlighting the use cases. While we invest seeking returns, be it short-term or long-term, what's really important for you to understand beyond the returns is risk. Lately, there has been a lot of talk about risk in mid and small cap segments of the equity markets, and hence we are taking time in this episode to walk you through some of the risks in this segment which you need to understand before making your investment decision. The first risk we are talking about is equity market risk, which is more general and related to overall listed equity assets, which are basically shares that you can buy and sell daily on stock exchanges. Prices of such shares change on a daily basis thanks to external news, constant demand and supply, sentiment, and expectations, and even announcements made by the company. This frequent change in prices is like fluctuations and impacts the daily return. In technical jargon, it's called volatility. Whenever you invest in equity, you must be prepared for short-term volatility. Over time, though, stock prices tend to reflect the business fundamentals of the issuing company, and hence you are invested in a stock or a basket of stocks like an equity mutual fund where earnings of the underlying company or companies is changing over time. The value of your portfolio or stock will also change. This is the reason that equity investing should be done with a longer time horizon rather than a return objective spanning a few months or just a year or two. Daily price volatility smoothens out over time. The next risk is of enhanced volatility. What I have just spoken about is the basic risk in equity investing. When it comes to mid and small cap stocks, the volatility which I explained gets enhanced or increases. This might mean that the actual fluctuations are sharper or more frequent, or both sharper and more frequent. The degree of volatility for each stock will be different, but for the segment on the whole, it is higher. This happens because mid and small cap companies are usually limited in terms of their business size and number of clients. Moreover, information, awareness, and analyst coverage for such companies is limited. Hence, it's expected that in any kind of economic stress, the earnings of such companies may get more impacted. On the other hand, because these are businesses which are smaller in size, there is an expectation of outsized growth in future earnings, which is what builds the expectation of higher returns when markets are moving up. Let me now demonstrate this volatility with some historical data. Let's consider 3 calendar years, 2017, 18 and 19. When we look at a large cap biased index like the S&P BSE 100 Total Return Index, it gained about 33.2% in 2017, 2.6% in 2018 and 10.9% in 2019. You will notice that returns are moving up and down. Let's move to the mid-cap index, the S&P BSE 150 Mid-Cap Total Return Index. This one was up 52.6% in 2017, was down 12.9% in 2018, and in 2019 it was up only 0.88%. Lastly, the small cap index, S&P BSE 250 Small Cap Total Return Index. This was up 57% in 2017, down 23.6% in 2018 and down another 8.4% in 2019. All three indices show price fluctuations, but the numbers tell us that the degree of fluctuation in mid caps is relatively more than large caps, and in small caps is higher than mid caps. Thus, mid and small caps outperform large caps on the way up and tend to fall harder when markets correct. One of the technical measures of volatility which mutual fund schemes are required to publish is standard deviation. If you understand this measure, you can use it to compare across schemes to determine the degree of volatility risk. Essentially, standard deviation measures how much returns can potentially move away from the average performance of a scheme in a defined period of time. So if the average 1-year return of a scheme over the last 5 years is 10% and it has a standard deviation of 2, it shows that the scheme returns can move higher than average by 2% on the upper extreme and fall 2% on the lower extreme. A similar scheme which also has, say, an average annual return of 10% but a standard deviation of 5% shows that the upper end it can gain 5% over average and also fall 5% on the lower end. Standard deviation by itself doesn't say much. When you compare across schemes in the category and against the benchmark, it does indicate which scheme is able to deliver more consistent returns versus others which may be more volatile. Higher standard deviation, the more volatile the returns of a scheme are likely to be. In general, the standard deviation of small cap schemes will be higher than mid cap schemes, which will be higher than large cap schemes. Within a category, you can use this measure to find which particular scheme is more volatile than the other. Also check whether higher standard deviation or increased volatility actually results in higher returns across periods or not. The next risk and very important risk you need to understand is liquidity risk. If you can easily sell an asset when you want to sell it at the price you ask for it, then it is considered a highly liquid asset. Listed shares, for example, are considered more liquid than, say, real estate, as with the latter it takes time to find a buyer and also the price is more negotiable. Even within equity shares, small and mid-cap shares are considered less liquid as compared to large cap shares. This is because the number of shares available for public buying and selling is relatively lower in case of the latter. For example, a large cap IT company has around 100 crore shares available to public, whereas a smaller sized IT company has around 20 crore shares available for public. In turbulent markets, when risk is raised, chances of a sharp correction also get raised. In such times, there could be a panic to sell. When that happens, the number of buyers reduces and sell orders are high. In such a scenario, first, the price of a stock with low liquidity as compared to the orders it is receiving can fall sharply. And in cases where liquidity is very low, there may be no buyers at all and investors can even be stuck with the stock for a while, even as price keeps on falling. In case of mutual funds, sharp market corrections can cause investors to panic and sell units of their mid and small cap funds. If that happens, it's important that the fund is able to sell its underlying shares to generate funds to accommodate redemption pressure. Mutual fund schemes now need to publish this liquidity analysis of their portfolios to say how long it will take for them to liquidate 25% and 50% of their portfolios, so that in periods of market stress, one knows to what extent investor redemptions can be accommodated and how soon. Price impact, of course, will remain. Mid and small cap fund managers will usually add in some amount of large cap exposure and hold some cash or equivalent securities in these relatively illiquid portfolios in anticipation of black swan events and sudden rise in market risk, which can trigger panic selling. With schemes now required to publish this information, you can check in to see how well a particular scheme fares on the basis of this analysis and how many days in which they can liquidate 50% of their portfolio. Individual stock selection in mid and small cap shares gains importance also because of their liquidity factor. Chasing return with very low liquidity can be highly risky. Hence, diversification in mid and small cap portfolios gains importance. The last risk we are talking about is deviation from benchmark. It's worth mentioning that mid and small cap universe of stock selection is much larger than the large cap universe. To that extent, the stock selection within a mid and small cap scheme may not have a great degree of overlap with the underlying benchmark index. This is not the case for large caps, where the universe is limited and a 30 to 50 stock benchmark already includes a great part of this large cap universe. Because of this nature of mid and small cap portfolios, scheme performance can be very different from the underlying benchmark, both on the way up and on the way down. And you should be aware of this aspect too. Given all that we have discussed so far, you should be able to tell that mid and small cap stocks, and hence the schemes which invest in them, by nature are riskier than large cap stocks. None of the risks we discussed above are in themselves a comment on the quality of the mid or small cap portfolio. As an investor, you need to understand this risk, focus on schemes which manage this risk relatively better, focus on good quality portfolios, and lastly, give your mid and small cap investments the benefit of longer time horizon in which you remain invested. Thank you for watching, and we will be back soon with another enriching episode to help you understand your mutual fund investment better.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.